All right. Okay. Good afternoon, everyone. Okay, we'll get started for today's session over here with the topic and the content to share with you more about order flow. Okay, the strategy to trade with what's commonly more popular known as smart money concept, right? In short, SMC. Okay. So before we jump into today's session, just some quick introduction about MQDemi, right? As well as VC Plus, some of the offers that you would want to take note of as well. Okay, and some housekeeping and before we jump into the actual content itself. Okay. Um, so first thing first, right? Welcome everyone. If you've not logged into your MQ account, make sure you do that. Okay, what you can do is if you're not logged in, okay, go and find this login button, okay, on the web page itself. Click it. Then a window will pop up. Just make sure you click login, fill up your particulars, and then click sign in. Okay. Now you want to log in so that you can actually accumulate the points for participating in this session. Okay, as well as when you chat and ask questions during the Q&A later, we'll be able to look at your name, okay, and it's not going to be some random numbers, right? And of course, we have the mysterious gift session as well, where we have some questions. So if you would like to participate in that, you definitely need to log in, okay? Yeah, so as I mentioned just now, if you log in and you participate throughout this webinar, this session over here, after it, you'll be able to get 300 MQ points for your check-in rewards. Okay, and the steps in the process is actually highlighted over here. You basically open an account with the selected platform. Okay, take a screenshot of this webinar itself to kind of prove that you are participating in this webinar. Complete the quiz, which will be sent over to you after this session. Okay, and basically you just need to upload the screenshot to the post quiz webinar, and then from there, okay, you'll be added 300 MQ points. Okay. There will be also mysterious gift, as I mentioned, at the end of the session. Okay, there are going to be 3 questions that we've prepared. So it's going to be the first 2 person who is going to be able to answer correct answer will actually get this mysterious gift worth up to 249 ringgit. Okay, so you definitely want to pay attention throughout this webinar so that when we proceed on to the questions during the mysterious gift segment, you'll be able to then quickly identify the correct answer and submit it. Okay. Now, over here, also very quick introduction about VC Plus. If you're not aware of it, okay, you can head over to the website www.vc-plus.com, okay, and go and register for your free account, right? So registering for an account at VC Plus is free. What you can do is you can log in, okay, register, log in, go and check it out on the platform itself, play around with the various features available, okay. And then, of course, once you are ready, you can actually verify your account and make a deposit and trade directly on VC Plus as well. Okay. Now, right now, VC Plus is also having a course as an exclusive offer. So it's going to be 100% discount, which means it's free. And of course, all you need to do is just join the webinar, open your account, make a deposit of $500, and you'll be able to enjoy the entire course for free. Okay. And of course, if you make, a variation of different deposit, you put in $100 deposit, you can get up to 30% discount. Okay. And if today you just basically open an account, join a webinar, you can also get a 10% discount, right? And this is only going to be valid until end of this year. So essentially, you're going to be only having like about 2 weeks time, right, before 2023 concludes. Okay. So again, if you'd like to find out a bit more about this office, feel free to scan the QR code, right, which you can see on the slide over here. Okay. And over here, we also have another trading contest, right? And this is actually already taking place since November all the way until next year. There's a typo mistakes, right? It's actually February 2024. Okay. And you have a chance to win an iPad, Apple Watch, or a Huawei phone. Okay. So again, if you'd like to find out a bit more information about this trading contest, that's the QR code on the right. Okay, basically the steps is quite simple, right? You just need to open an account, make a deposit, join the contest, make some trades, and you potentially can win these prizes over here. All right, so again, if you're interested, quickly scan this QR code, right? Or what you can do is you can quickly take a snapshot of this QR code first, and then after the webinar, you can always go back to the QR code, scan it, and check out more information. Okay. So over here, if you want to keep yourself updated in terms of trading information, in terms of any future exclusive offers or events that VC Plus is going to have, you can join the chat over here. Okay, again, QR code, scan it. Okay, I would strongly suggest you just take a photo right now. And then after the session, you can always go back to the QR code itself to check out for more information, right? But for now, quickly take a snapshot. Okay, and then later, as the webinar concludes, you have more time to actually just go through those information, okay, at the convenience of your own time. Okay, good. So with all that said, I hope you guys are ready. Okay, and just a very quick chat. If you guys are ready, do let me know by typing a 1 in the chat so that I know you guys are still here. And then just a very quick double confirmation in terms of all the technical aspects of audio. In terms of the screen sharing, you guys are okay, able to hear. Do put in a 1 so that we can get started for the content. Okay. So yep, I see over here Rock put in a 1, so I think everything should be fine. Emily as well. Okay, so yeah, we jump straight into today's content. Okay. Now, so today's content here, the title as we put, right, is called Order Flow Mastery. There are some different terminologies or say names that traders give it, right? I call it order flow. Some traders call it smart money concept. In short, SMC. I think that's a very, very popular concept in the recent times. But I think the principle is more or less the same. Okay, and today is essentially sharing with you the understanding of this, the principle of this strategy, and if it fits into your personal style, then of course you can use it for your own trading as well. Right. So some of the things that we're going to cover today is to, of course, understand the key terminologies in the order flow strategy. Okay, because there are some terms that would be very new. Okay, if you're not familiar with SMC or you're not familiar with order flow. Okay, so we'll introduce you to those terms, those principles, and those are important because when we look at the market, when we use this strategy to execute trades, you need to identify those conditions and criteria accordingly, right? So the terminologies are important. Then we'll cover the application of three trading styles, right? When I mean three trading styles here, we are talking about, are you more of an intraday? Are you more of a shorter term trader, or are you more of a swing trade? Okay, so we can use the same principle to trade short term. We can use the same principle to trade swing. It's just a matter of like the application on time frame perspective, right? Which we'll cover in details how you can do that. Okay, and last but not least, we'll be actually applying that directly into a live market environment. Okay, to kind of also highlight where are some of the opportunities within this week so that you can keep an eye on it. Okay, and you can see the direct application of this strategy. All right. So okay, with that said, did not really have a disclaimer slide here, but just want to highlight, everything that we're sharing today, okay, of course, is not going to be constitute directly as a form of trade advisory or investment advisory. They are purely for educational purposes, right? And if the trade works out, that's great, right? But be aware that, of course, trading involves risk. Okay, so there's something to put it on. Okay, now, first terminology that you want to be aware of and you need to know is this thing called liquidity. Okay, now liquidity carries slightly different understanding depending on which principle you're applying it to. Okay, I mean liquidity in general, it just means how easy you can transact, right? That's liquidity in general. But when we are coming into order flow, when we are talking about smart money concept, liquidity refers to an area basically where the bigger banks or the smart monies, would like to actually go towards that area to collect orders before moving eventually, right? So when we talk about liquidity in the smart money concept, or when we talk about liquidity in the order flow principle, okay, we are often talking about smart money. We're talking about like the bigger players in the market. Okay, so today, if a bigger player would like to buy a specific asset, right? Whether is it a currency pair or is it like a commodity or whatever it is, right? If today a smart money wants to buy something, they need to find an equivalent amount of sellers, right? And that's basically the principles behind how money works, right? Or how the market works. Today, if you want to sell something, you need to find a buyer. Today, you want to buy something, you need to find a willing seller. Okay, so vice versa, right? So the whole idea of it is that for the market to actually function, it needs liquidity, right? And if everyone just buys and nobody wants to sell, then there won't be any transaction, and basically the price would just go up, 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 right? Because the demand increases, but there's no supply, right? And the opposite is true, right? If everyone just wants to dump it off, everyone wants to sell, and nobody wants to buy, then there's like massive supply in the market, but there's no demand, and then prices would drop, right? So that's essentially the function of liquidity, okay? And during in a market where we are trading buy and sell side, right? Liquidity is not in a specific direction, right? Liquidity are basically orders, okay? Because if today you buy and you put you put a stop loss, your stop loss order is essentially a sell order, okay? Because you buy, you want to cut it, it's basically selling off into the market, right? And if today you sell and you put a stop loss, then your stop loss is essentially a buy order, okay? And of course, there are also traders who look to trade breakout, right? So when price actually breaks out of a certain price point, they would like to execute an order, whether is it a buy breakout or a sell breakout. Okay, so those are all liquidity in a nutshell. Okay, basically orders in the market, whether buy or sell, they contribute to liquidity. Okay, and what these bigger banks and smart monies would like to aim for is to actually look for the areas where there are liquidity, move price towards it so that they're able to execute their order, right? Because if they want to buy, they need to find sellers, as I mentioned. If they want to sell, they need to find buyers, right? And where are these sellers and buyers? They are often at a certain areas on the chart where they know, there's a lot of breakout orders, there's a lot of stop loss, and those are all orders that they want to catch, okay? So where would the most obvious areas that very very mechanically we can identify, which means that you don't really need to guess, right? And these are the three components that I've highlighted over here, right? The most obvious areas are going to be our monthly high and low, our weekly high and low, as well as the daily high and low. Okay. Now, obviously, there are also some areas like psychological numbers, which again have a lot of traders putting in orders around those areas. You can also identify like key significant support and resistance and things like that. Okay. But today we're gonna just focus on this three. Okay, monthly high and low, weekly high and low, and the daily high and low. Right. And when we're talking about monthly, weekly, and daily, we're always talking about the previous one. Okay. So if like today we are in December, right? So when we're talking about monthly high and low, obviously we're not looking at December high and low because the month hasn't concluded yet. So we are looking at November high and low for the month one. Okay, for the week, then of course today is Tuesday, so we're not looking at this week high and low because it's still developing. Okay, when we are talking about week, we're looking at previous week, right? Same thing for day, right? Today is Tuesday, so the high and low for the day, we're not looking at today, but we're looking at Monday. Okay, so that's the logic behind it. Okay, so let me very very quickly show you. This is a chart on the monthly time frame on euro dollar. Okay, so what you can see over here is I've highlighted some lines, right? So you can see each candle is a monthly worth of data, right? So you can see starting from this, you can see the red candle, right? So that month actually came down. That's the low. Okay, so if you put a horizontal line, you can see the next month how the market actually sweeps the low and then bounce back up. Okay, not all the time it's going to bounce back up, but you can see the concept of how that's being applied, right? Low point gets swept, pin bar did not really break and close. It broke it, but did not close, and then it went up. Okay, same thing here. You can see, monthly high, the market came close, sweep it, and then come back down. Here as well, monthly low, sweep it, and then go back up. Okay, so this is the first principle that you want to be familiar with, right? To identify key areas where there would be significant liquidity and the market would tend to move towards that area. Okay. Show you in another time frame. This is on a weekly scale. So every candle is a week's worth of data. So you can see here as well, weekly high sweep, come back down, right? Weekly low sweep, go back up, weekly low sweep and go back up. Same thing here, sweeps, gone up, right? So obviously not all highs and lows, you just take it, right? But there are more conditions that needs to be fulfilled before we execute a trade. But basically all these significant areas of high and low, monthly, weekly, daily, high and lows, they are going to be an area of interest, which means we're going to pay very close attention when the market breaks this area, because that's where it starts to sweep the liquidity. Okay, these are daily charts. You can see how, certain high and lows often like to be swept, and then it just moves in the opposite direction. All right, so same thing here, right? You can see this is low. It kind of swept the liquidity below it, but did not really break and close below. Same thing here as well. Okay, same thing here as well. This one part here as well. Okay. Okay, so just want to very quickly highlight the significance of dailies, weeklies, as well as monthlies, high and low point. Okay, so that's the first principle. Okay, we call it liquidity. Where the liquidity is, you need to be familiar. Okay, now the second principle in the order flow mastery concept, right, is called order blocks, right? Or some traders would just call this supply and demand. Okay, so order blocks are, how do we identify? They're basically, or I would say demand and supply. How do we identify it? Right. So for bullish order block, which is demand areas, we are looking at the last bearish candle before a bullish move that breaks market structure. Okay. So basically, it's like the last bearish candle before the bullish move gets started. Okay. That's where the order is, right? That's where the demand area is, right? The opposite is true. Okay. Bearish order block is where the last bullish candle is before the market actually breaks market structure, right? So let me just show you the chart to illustrate that. Okay, so if you take a look at this chart here, right, the market went up, it does a pullback, and then after that it went up, right? And you can see this up move here break the previous swing high. Okay, so in short, we call this BOS, break of structure, right? So when we get a break of structure, we then identify the last. Okay, this is a bullish break, right? So what we identify is the bearish candle that contributed to this break. Okay, and where's the bearish candle here, right? So this entire piece here is the bullish order block. Okay, not difficult, right? It's quite straightforward. Very mechanical definition, right? You get a break of structure. Okay, you identify the opposing direction candle, and then that becomes your order block. Okay, so bearish side of things, same thing, right? You can see where did the market break of structure here, right? Break and close below that swing low. Okay, then where is the last bullish side? Right here, right? So that's gonna be your bearish order block. Okay, so we call this demand and supply. Again, the different terms, but the principle is the same. Okay, so that's order block, right? Now, order blocks, if you kind of start to look for it, in the chart, you'll be able to start identify a lot. Okay, but how do we then identify a significant order block? Okay, we have this principle called fair value gap, right? Some terms that traders use to replace the name on fair value gap, or FVG, is market imbalance. Okay, it basically means the same thing, right? It just the idea where there are certain areas in the market where there is imbalance or inefficiency, right? And often these areas of fair value gap tends to attract price back to it. Okay, so they tend to act as a magnet where the market price would tend to go back to it to fulfill the imbalance, to fulfill the inefficiency that was created as it was moving. Okay, so we often use these areas for potential entries as well as potential targets. Okay, so do take note of that. As we start to build up the strategy and the trade plan, there are some principles you need to be familiar, right? So let me very quickly show you fair value gap and how to identify it. Okay. Now the principle of fair value gap, or how we identify it, is we need to first identify three candles, right? It's a three candle pattern. Now, if you take a look at this one here, you can see the first candle, okay, as this is coming down, right? The first candle and the third candle, there is no overlap. Okay, the low of the first candle is here, the high of the third candle is here. So there's actually a gap, right? There's a gap between the first and the third candle. Okay, and that gap is what we call FVG, right? Fair value gap, right? That's the market imbalance. Now, if you take a look at this part here, right, this candle low, this candle high, again, we have a bit of gap, okay? So that's a fair value gap, okay? Now, if you take a look at this here, right, you can see this candle and this candle, there's no gap, okay? Because the high and the low of this candle is being overlapped on the third candle, right? So the idea of it is we want to search for areas in the chart where we have obvious gaps. Okay, this becomes some key areas as well because they tend to act as a magnet. Okay, more examples. You can see over here, right? This is very huge fair value gap, right? First candle, third candle, huge gap there. Okay, so what tends to happen is the market would likely be attracted back towards this area here because it needs to fulfill that kind of imbalances, right? Now in the past, you can see over here, right? We have this gap here. The market came down, fulfilled that gap, pushed back up, created another gap. The market came back down, fulfilled that gap. Okay, so this here, what is the expectation? It would likely go back and fulfill the fair value gap. Okay, so that's usually how we understand fair value gap. Okay, and how we identify fair value gap. Cool. Okay, so we have market order blocks, right? We have fair value gaps. You also need to understand the term break of structure. In short, is BOS. Okay. Now, break of structure is quite simple concept to understand. It basically refers to break and close beyond certain swing points, right? The keyword here is break and close. It needs to break and close. Okay. And this often suggests a trend continuation. Of course, if the market is going up, we get a candle which break and close above the previous high, then that's a bullish market structure, right? If it's the opposite, where we get a market candle coming down, break and close below it, then we have a bearish market structure, right? So to show you some example, right? You can see over here, we have swing high, the market pull back, it goes back up, the candle break and close above that swing high, bullish market structure. It pulls back, it continues to have another candle break and close above that high, bullish market structure. Okay. So you can see the BOS keeps happening until at one point in time, this high no longer get broken and close. Okay. And we start to have a reversal in things, right? Because then the swing low gets broken and closed below, right? So that's what we call a potential trend reversal. Okay, because you can see here, right? Swing low, swing low, swing low. None of the swing lows is taken out. Okay, there's no candle that break and close below that until this part. Okay, so this is the part where we have this term called change of character, right? It's just basically suggesting that that's the very first break and close in the opposite direction and suggesting a potential trend shift. Okay, so BOS is basically that principle, right? Give you another example in the opposite side of things. The market is coming down with swing low, swing high, did not get broken, but your swing low gets broken and close. Okay, so those are what we call BOS, and that's where you have a bearish market structure. Okay, now just want to quickly talk about change of character, right? In short, is CHOCH, change of character. Again, this just basically indicates the trend may be shifting and it's a potential reversal, right? It's the same exact principle as break of structure as BOS. It's just that change of character, we use this term when we get the first opposite direction of BOS. Okay, so let me show you an example on things. Okay, so this is the exact same chart that we get break of structure to the upside. And then this is the very first time we get the opposite break of structure, right? So the very first break, the opposite break of structure, we just usually label it as change of character, right? Now, to me, I think the terms is not that crucial, but at least just understand that, as we get break of structure to the upside, we're in a bullish market structure. But when we get our first reversal, okay, that's where you need to be cautious, right? Because the swing low has been taken out. It suggests that, okay, maybe the bullish market structure is shifting and you just need to be a bit cautious or even start to look for new potential trend to the downside. Okay, so that's what change of character essentially means, right? This one here as well, you can see it's coming down, coming down. We get a swing high that's broken and closed above. Okay, the key is close, right? It cannot just be break, it needs to break and close, right? So that's change of character, right? So once we understand these few principles, this is where we can start to put things into a strategy itself. Okay, so over here, I'm going to share with you 3 different styles: short-term, intraday, as well as swing. Okay, so let's start with the short-term, right? Short-term is essentially looking at a 15-minute chart. The first step is to identify the previous day high and low. What is that? That's basically liquidity on the daily scale. Okay, so we want to look for the previous day high and low. Identify where it is. You can put in a line, and then the step after that is to focus on the 15-minute chart, right? Because you're looking at short term, you're looking at a 15-minute. Okay, and the third step is basically wait for liquidity sweep, right? What I mean by that is we already identify high and low on the previous day. So on the 15-minute chart, what you want to see is you want to see price break above the high and low to sweep the liquidity and reverses back by giving you a change of character. Okay, in a while I'll show you in some charts, right? And then after you get a change of character, that's where you identify, okay, where is my order block? Where's my demand supply? Where is the fair value gap? And then we'll look for entry around the order block. Okay, and then of course, the typical stop loss that we use is around 15 to 30 pips, and you have your target set at previous day, the opposite high or low. Okay, now you can also use some fair value gaps to identify your targets. Okay, let me very quickly show you an example of it. Okay, let me just see which one I've identified to talk about it. All right, Aussie dollar has something. Okay, so if you're looking at if you're looking at short term, right? So the first thing we look into, okay, is to go over to the daily, right? And you want to identify the previous day high and low, right? So in this case here, you can see, okay, this is today's candle, so that's yesterday candle. So yesterday candle high point is here, okay? And then of course the low point is here, okay? So once we identify the high and low, okay, so I'll go back to the slide, yeah? First step, identify previous high and low. Then we go to a 15-minute and we wait for a liquidity sweep, okay? So what do we have over here? We go over to the 15-minute, okay? And then you can see, right, what we have is that the 15-minute has actually swept the liquidity of the previous day high. Okay, that's what we want, but we don't enter immediately, right? What we want next is to wait for a change of character, right? So why is that the case, right? If you take a look at the 15-minute chart, what is the current bullet? What's the current market structure? Is bullish, okay? Why? Because we have break of structure. Whoops. Okay, let me thicken this a little bit so you can see. Okay, what we have break of structure here, we have break of structure here. Of course, we also have break of structure here, right? So the entire market right now is bullish. Okay, so we don't want to be selling immediately. What we want is we want to wait for a change of character. Okay, and when are we going to get a change of character? Right now, what do we have? Right now, we have this as a potential swing low. Okay, so if today we can get the market to come back down, okay, break and close below the swing low on the 15-minute chart, then what do we have? We have a change of character. Okay, so when we get a change of character, that's where we start to identify order block, fair value gap, and then start to look for trades. Okay, so let's visualize a little bit. Okay, let me see if I can bring in some candles. Okay, let's visualize a little bit. Okay, I'll take this candle here, right? Okay, so visualize, this happens. Okay, so let's say we have like this happen here, right? So what do we have? Okay, we have the change of character. Okay, we even have this here. So we then have a change of character. We then identify order blocks, right? So where would that order blocks be? Here. Okay, and what does it mean? You want to then wait, okay, for the market to pull back into this area and then look for a sell trade. Okay, and your sell trade usually on the 15-minute chart, right, would be giving you about 15 to 30 pips stop, right? So this is pretty tight, right? So if you take a look at 15 pips, somewhere up there. Okay, so that's somewhere between 13 to 14 bits, right? So you have sufficient room for the market to move. And where can you put your target? Okay, you can actually use back the daily previous low. Okay, so this is previous daily low. Okay, so going back to a 15-minute chart, that will be a target. Okay, now you can also use some previous fair value gap to help you identify areas of targets, maybe your partial profits and things like that. So you can see over here, we do have a little bit of fair value gap. Okay, so maybe your first take profit will be somewhere there. Okay, and then you can go for second take profit at the previous day low. You can follow that, right? Okay, so that's the summarized version on the 15-minute. Okay, now if you're looking at intraday, right? So if you're looking at somewhere between the 30-minute time frame of trade, okay, this is where you use the same process but a slightly different time frame, right? So for the first step to look for liquidity sweep, we use the weekly chart. Okay, we use the previous week high and low for our key areas of liquidity. Then we look at 30-minute, wait for the sweep, wait for the change to character, look for order block, look for fair value gap, identify entries with stops ranging around 20 to 30 pips, and then your target. You can use fair value gap as your target. You can use your previous week high and low as your target. Okay, so the steps are exactly the same. It's just the time frame usage is different. Okay? So if today you're a swing trader, then you'll be looking at a forward chart. Okay, and on the forward chart, we'll be using the monthly scale to identify liquidity. Okay, high and low will be our obvious monthly liquidity chart, right? So then we go to the 4 hours, same process. We wait for the sweep, we wait for a change of character, then we look for entry, right? And most of the time, the entries is somewhere between, the stops will be somewhere around 40 to 60 pips, and the whole thing is the same. Okay. Now, let me jump back to Aussie dollar to just very quickly show you an Aussie dollar on the 4-hour time frame. We do have something as well, right? So not only on a 15-minute today, we may have a very short-term trade, right? Aussie dollar may have a swing trade opportunity as well. Okay, so if you take a look at the monthly here, okay, we have the previous month high and low. Okay, now if you go down to the 4-hour chart, okay, we have this sweep. You can see that, right? Okay, so that's what I meant by liquidity sweep, because that's the month high. This month, the market actually went up, broke it a little bit, but they're not really close. Did not really continue. It starts to give us what? It starts to give us a change in character. Okay, it gives us a change of character. Right? So if I drew a dotted line, you can see that, right? So the market reverses, break and close below that swing low. That's what we call a change of character. So once we get the liquidity sweep, we get the change of character. What do? We identify order blocks, right? So where is our order blocks? Somewhere around here. Okay, that will be what we call your supply zone. Okay, where is our fair value gap? We do have a little bit of a fair value gap over here. Okay, you can see that. Okay, so what are we expecting right now? Okay, we'll be looking at potential sell trade. Okay, if the market actually does a pullback. Okay, if the market actually does a pullback towards the supply zone, we'll be looking for a sell. Okay, now from here you can add in a little bit of fibs to guide you a bit, right? So what we can do also, we can take fibs, right? Stand to the right. Okay, okay, so this would be good. Okay, so some of the fibs you can consider looking out for. Okay, let me just use this too. Okay, you can look up for the 71 and 79 Fibonacci, right? It's not some magic number. It's just basically most of the time it's quite close to the supply zone, right? If you don't want fit, it's perfectly fine as well, right? You can take away the fit, and then you say, okay, I'm just gonna look to enter around that supply zone with a stop around maybe 40 to 60 pips, right? That would be good. Okay, and then of course your target, you can use previous fair value gap, you can use the previous month low, etc., right? So if you don't want to use fibs, it's perfectly fine. If you want to utilize a little bit of fib to give you some, exact precision point in terms of your entry price point, you can look for one entry around the 71. Okay, then your stop will be maybe about 60 pips above that swing high. Okay, and then your second target, second entry is around the 79. Okay, stop loss is about the same at the top, and your target's bottom. Okay, now you can aim for some of the market imbalances area that has yet to be targeted, right? Which means your previous fair value gap. Okay, so you can see this fair value gap has been mitigated, so nothing there. This fair value gap has yet to be mitigated. That can be a potential target, right? We have a massive fair value gap here, but this one has been mitigated, right? You can see over here it has been tagged, so this one probably not so crucial. So what you can look up for is this can be your TP1. Okay, and then you can aim for like TP2 at your previous month look. Right, so that's how you can look up for trades. Okay, now if you are even more conservative, you can even consider like previous month, not previous month, but previous swing low as your target one. Okay, and then what will be happening is you have TP1, you have TP2, and then maybe that's going to be like the final take profit, TP3. Okay, so very mechanical strategy that you can actually utilize based on the principle of order flow, okay, or smart money concept. Okay, so that's an Aussie dollar, right? We have something there. Let me quickly check some other opportunities that we have. Okay, another one is actually gold. Okay, XAU USD. Okay, so this one is also on a swing trade idea, right? So again, if you go to the monthly, okay, you can actually see over here, previous month high, previous month low. Okay, and then you start to go to the forward chart. Okay, what we have, liquidity sweep, come back down, break and close below this area. Okay, break and close below the swing low. That's a change of character. Okay, that's a change of character. So what we do next, we start to identify fair value gap. We start to identify. Okay, so as the market comes down, you can see, we have this push down, and then we have a slight retracement or a kind of like consolidation over here, and then market continue to drop, right? So in fact, we even get a break of structure over here. Okay, so as we continue to look for opportunities, right, where would be the supply zone that we can look out for? Okay, this zone, right? Of course, why? The market had a break of structure. Where is the previous pullback? Somewhere there, right? That's the supply zone. Do we have a fair value gap? We have this fair value gap area here as well. Okay, so naturally what we'll be expecting is for the market to actually pull back towards the zone. That's why we're going to continue to look for sell, right? That's the expectation of it, because the market is making lower low, lower high. We have a bearish market structure. We have a liquidity sweep. Where would be our final target? Previous month low. Okay, but of course we have multiple targets we can also aim for, right? So that's where you want to also identify previous fair value gaps that has yet to be fulfilled. This one here you can see fulfilled already. Okay, we call the word mitigate. Basically, it's been touched, right? This one here as well, fair value gap has been mitigated. So far nothing really there, except for this one here, right? Which is already very, very close to the previous bottom. Okay, so kind of remove this here. We kind of have a little bit of target areas. Okay, now of course what we can also look up for is previous demand area as some of the key target areas to look up for, right? So there are definitely a lot of all this, right? You don't want to overcomplicate the stuff. Okay, I mean, at the end of the day, if the market is really coming down, you're making profits, it's really up to you how it's going to catch. But I would say target is naturally at the previous month low. Okay, whether you're gonna get that or not, we don't know, right? But you basically manage your trade anyway. If it's moving in your favor, right, you're gonna take partial profits, you're gonna shift your stops, trail your stops, etc. Okay. So over here, if you go back to the entry focus, right? So how can you do it? You either look for an entry directly at the supply zone. Okay, and then of course you put a stop just above that. That's one way to look at it. Or you can use your FIB, right? So what you do is from swing high to swing low. Sorry, this part I need to adjust again. Okay. Okay, so 0.71, 0.79. Okay, so 0.71 basically lines up very nicely with that, right? So that would naturally be your entry anyway. Okay, and then you can play around with double entry. Okay, so gold is another opportunity that we have, right, in terms of the strategy over here on a 4-hour scale, right? So that's more on the swing side of things. So far, so good. Can, right? Okay, now some of the yen pairs are also giving us a opportunity. Okay, pound yen. Okay, pound yen over here. Oops. Okay, so mostly on the swing side of things, right? So if you go to the monthly, okay, what do we have? Previous month high, previous month low. Go to the 4-hour chart. Okay, the previous month low, you can see market break below it, scoop liquidity, bounce back up. And then what we have right now, we have a change of character. Okay, you can see that, right? Change of character. Okay, where the previous swing high has been broken and closed above, potential change of character, right? So where is the final pullback before the change of character happens? Here, right? This bearish candle over here. So that becomes our potential demand zone. Okay. Do we have a fair value gap here? We do have a little bit here, which the market is currently mitigating. Okay. So what we can then expect over here is this change of character seems to suggest a potential reversal after a liquidity sweep. So our expectation is essentially if we can get a pullback towards this demand zone, we can potentially look for the buy, right? Again, if you're pulling FIBs, you can also do the FIB areas. Okay, so 0.71, 79. Okay, and then again, the area kind of aligns quite nicely in the supply, in the demand zone, right? That would potential buy here. Stops just above, sorry, just below. Okay, this stop is a little bit wide because we are looking at like a larger volatility instruments, right? Pound yen is pretty volatile. Then where would be your target be? You know, you can of course look at previous fair value gaps that has yet to be mitigated. This is pretty obvious. Okay, there are some fair value gap over here as well. Again, of course, the most conservative, you can just aim for that as TP1. Right, you can first aim for the previous high here, TP1, right? Then maybe target 2, target 3. Okay, so yeah, your risk reward is definitely going to be there, right? Because we are looking at FIB ratios, right? Entering at 71%, 79%, you stop below it. With just aiming at the first high here, you can see your risk reward is about 2 point something. It's definitely there because it's proportionate, right? In terms of like FIBs ratio, it's definitely going to be proportionate. Okay. So you can see, right, we do have a couple of opportunities to keep an eye on this week. Right, so I'm going to open up the remaining time for Q&A. I do see some questions coming in. Okay, so we'll be answering those questions. If you have more questions, feel free to just drop it into the chat. I'll be looking at them and answering your questions right now. Okay, so Rockazar here says, some of the gap is big and some is small. How do you identify the small and big gaps? Is the gap, okay? You always want to focus on the bigger ones, right? Because when we look at fair value gap, the principle behind it is basically market imbalances, right? Which means that the bigger the gap, the stronger the momentum is going to be. Okay, so for example, Okay, look at this gap, right? This fair value gap here is huge, right? What does it mean? It means that the momentum is huge, right? But this is then mitigated. Okay, now there are some gaps that are very, very small. Okay, now look at this here. Okay. Okay, look at this gaps here, right? I mean, this gap is pretty small, right? Okay, so you don't want to be looking out for every other gaps, right? Your idea here is you always focus on the first few principle first, right? Liquidity squid, we have a change in character. Do we have an obvious supply demand? If we have a kind of obvious order block, then we start to look for, okay, where would be the fair value gap? Is there a fair value gap near the order block? Okay, because if there's a fair value gap near an order block, it means that the order block is pretty strong. Okay, it created a market imbalances, right? Now let me show you an example where we may have, I mean, everything is there, but we don't have a fair value gap. Okay, so if you take a look at let me show you, right, in terms of dollar Canadian. Okay, let me just check the time frame over here that I have. Yeah, it's the monthly and the 4-hour chart, right? Okay, now so if I show you the dollar Canadian, right? Dollar Canadian, this is our previous month high, this is our previous month low. Okay, we go to the 4-hour chart. Okay, we have that break and sweep of liquidity, you can see that, right? And then after that we bounce back up. Obviously we have a change of character. Okay, I mean, you can take a look at this swing high, we can't break and close, that's a change of character. Even if you take this swing high, we have a break and close, we have a change of character, right? So change of character is there, okay, which starts to suggest that, okay, this may be potentially reversing to the upside. Do we have a demand area? Yes, we have, right? Because this is where the bearish candle is. But when we identify the demand or the order block, right, the bullish order block, we don't really see a fair value gap throughout this entire move. Okay, throughout this entire move, there's no fair value gap, right? You can't really find anything, right? So what does this suggest is that maybe this order block may not be something that we want to be trading, okay? Because this order block did not create something that causes a market imbalances, right? This order block did not create sufficient momentum to give us the market inefficiency. We do not have a fair value gap, right? So these are order blocks in which that I would probably want to avoid, right? Which means you probably don't want to like kind of execute trades around here first. You want to wait for more confirmation, right? So what can happen, of course, is this can continue to, it may not come down here. It may just continue to go and break above it. Okay. And then what we get a break of structure. And then from that break of structure, naturally we have a new potential demand zone, right? And maybe then that would have another fair value gap around there created. Then what we do, we trade this order block. Can follow that thought process, right? Because over here on the 4-hour scale, where is our final target all the way up there, right? Essentially, we're still looking for buy as long as price is there. But right now, this current order block doesn't create a fair value gap. There's no market inefficiency. It may not be a very strong order block. You may want to be a little bit cautious. Okay, so that's the thought process of it. Okay, yeah, so that's where to address the part on small and big gaps. The bigger the gaps, the bigger the momentum is, right? But you don't want to get too hung up upon like finding every fair value gaps that you can see. Okay, you just identify the obvious one. Okay. WCK asks, can repeat the sweep off part, right? So the sweep off part is quite easy. The idea of it is basically depending on the time frames that you're working on. Okay, the highest time frame here we're looking at is a weekly. We always identify the previous high and low, okay, of the previous data, and then we go down to the relevant current time frame, like H4 over here, and then we basically wait for the market to sweep through the previous high and low, right? So I give you an example on, let's say, euro dollar. Okay, now if you go to euro dollar on a monthly chart, okay, what do we have? Previous month high, previous month low, right? And then if you go down to the 4-hour chart, we are currently in the middle of it, right? So this kind on the 4-hour chart, perhaps we won't have any opportunity in the near term because we always want to wait for what? We want to wait for the market to actually sweep liquidity in either side first, then we look for areas of entry there. Okay, so on the 4-hour probably nothing on the euro dollar side of things, right? So you can of course then look at multiple time frames, right? So if you today you work on maybe on the weekly, okay, we have a weekly low, we have a weekly high, okay, and then you play around with the 30-minute time frame. Do we have anything? Not yet, right? So some charts you really have nothing. Okay, so on the daily, okay, do we have a daily high? We have a previous day high here, we have a previous day low here. Going down to the 15-minute on the short-term trades, do we have anything? Nothing as well. Okay, yeah, so the sweep off part is essentially identify significant high and lows, right? For today's purposes, we are just sticking to time frame high and lows, right? To keep things very simple. As I mentioned at the very beginning, some of the psychological number can be strong areas as well, right? Like what I mean by psychological number is, if you take a look on the chart, right, we have some very nice psychological number like 1.09000. That's a very strong psychological number, right? 1.1000. That's also a very strong psychological number. You can see that sweep in liquidity, right? It breaks off a little bit and then it comes back down. Okay, that works too, right? You can see as it comes down, there's a change of character. There's even a break of structure there. Okay, and then of course on the smaller time frame, you wait for the pullback. That's the sell. Okay, so those are the understanding of it, right? So take a look at this here as this area around 1.0900. Again, it's a strong psychological number, right? Liquidity sweep, go back up, right? Look at, I mean, it's not going to be perfectly specific at that zone, but it's an area of interest, right? Okay, so you can see areas where market tends to react. Okay, yeah. So those are what we meant by key levels, right? So psychological number is definitely key level. Significant highs and lows like your monthly, weekly, daily can also be areas of interest. Okay, how does news and major market news impact order flow, and how can traders navigate these situations? This is a question from Emily. Obviously, the smaller the time frame you go into, like 15-minute, 30-minute, you may want to be very aware of certain specific news, especially on high impact news. You maybe want to avoid it. Like this week we have the Fed coming in, right? PI data coming in, right, in terms of the US side of things. So if you're trading on a 15-minute and 30-minute, you might want to avoid taking trades because the fundamental news can sometimes just shift the entire price move. But if you're looking at more like the 4-hour chart, I think you don't need to be overly concerned, right? Because you're looking more of a longer term perspective, right? One single news may not shift the entire thing. But if you're looking at 15-minute, 30-minute, obviously my suggestion is to avoid taking trades or trading during a very high impact news like USDPI, the Fed funds rate. Okay, those are things that I probably want to avoid. Okay. Crayon Lee asks, how can we manage risk with this strategy? I think very simple, right? We talk about stop loss and things like that. Okay, so basically you just calculate the width of the stop loss and then put in the calculation in terms of like capital balance and things like that to calculate out, what is the percentage of risk that you want to put in relevant to your account balance, and then calculate the proper lot sizing. Okay, so quite straightforward. I mean, the entry, you have your entry price point, you have your stop loss, you have take profit. It's just typically how you manage, risk similarly to other strategies as well. Okay, so the bigger the gap, the better for reference. Yes, right. As I mentioned, the principle behind the gap is market imbalances, market inefficiency. The larger the momentum is, right, usually the larger the gap is going to be. So far so good. Okay, yeah, so those are the questions I've seen so far. I hope that can answer your questions. Okay, and of course I've kind of highlighted some opportunities to keep an eye on for this week, right? You have the Aussie, you have the yen side of things, and then you have gold chart that I think potentially have something that you can take a look at. Okay. Can you apply this in the equity side of things? The answer is yes, right? I mean, but of course, you also need to wait for the conditions to fulfill, right? So, for example, Nasdaq. Okay, same principle, right? If you take a look at monthly here, we may have the break above the previous month high already, so that might be a potential liquidity sweep, right? On a forward time frame, that just broke it, right? But we don't have a change of character yet, because if we want to wait, we want to get on a sell, we need this to come back, break this low to give us that change of character. Then only we look for the sell, right? Okay, so we may get something, but not so soon, right? On the weekly scale, okay, we also have the break of the previous week high, but of course we probably would not have the change of character at the moment yet, right? There's no change of character at the moment. Okay, so yeah, nothing there. Okay, yeah, so Nasdaq, I mean, you can apply the principle, it's just that, you just need to be patient and wait for the conditions to fulfill. Okay, sorry, let's check maybe German DAX. I know German DAX is like going up very strong, right? Yeah, it's basically going up very strong, but you can see, okay, so if you take a look, like, of course now it's a little difficult to look at it because it's some time back, right? But you can see this drop here, right? That month in September, then October we have that liquidity sweep on the monthly scale. Okay, actually on a forward chart, you may get something there, right? Back then, okay, I mean that's like historically, just to show you an example, right? You can see this here. Okay, now we have that break, we have that change of character. This is maybe a short-term trade. You may have gotten something there as well. Okay, and then after that you get another sweep and then another break, right? So you can see this is a change of character here. Okay, but of course we don't get a pullback to enter the trade, right? So we have everything fulfilled, but sometimes the market doesn't pull back sufficiently to give us an entry. Then we'll just take it as a missed trade. Then we look for the next opportunity. Okay. So I just want you to know, not all the time you get all conditions means you're gonna get a trade, right? The condition require us to also wait for the pullback to get involved in the trade, right? If you don't get a pullback, then you probably won't have that trade either. Okay. So very quickly, just show you some examples here on the screenshot perspective, right? Weekly high, weekly low. You can see that. Okay. So we got the break above that week high. So that's what we call a liquidity sweep. We look for the change of character. Okay, and then we look for the order block. Okay, we have this order block here, and then of course that was an opportunity to take the trade down, right? But this is already like happened, right? So that's where today I want to show you some opportunities that are still available in the market. Okay, for the week itself, or even going into next week. Good. Okay, so with that, we'll go over to the mysterious gift session. Okay, for the remaining time here. Okay, so what we're gonna do for this session over here is I'm gonna flash a question, and the first two-person who gets the correct answer will win the gift, right? And if you are kind of selected as a winner, right, what you want to do is to fill up your information on Google form, right? So the MQ Trader can actually send you the gifts itself. Okay. So basically, it's a multiple choice question, right? A, B, and C, or D. Then you just need to select the correct answer and then type it into the chat. Okay, so the first two-person who got it right will win it. Okay, ready? So the first question over here is, where are the key liquidity areas, right? A, previous support resistance, B, previous high and low, C, order block areas, and D, fair value gap areas. Okay. Keyword here is key liquidity areas, right? Where are they? A, B, C, or D. Okay, these are not entry areas, right? I just want to be clarifying again. These are key liquidity areas that we shared in today's seminar, right? So the answer here is previous high and low, right? So we talk about previous monthly high and low, previous weekly high and low, and then previous daily high and low as key liquidity areas, right? So over here, what I see is all right, congrats to HFloat07 as well as WCK Rich. Okay, so yeah, fill up the Google form, right, with your details so that MQ Creator here can send you the gifts. Okay. Now, next question: How do we identify order blocks? A, last opposing candle before the break of structure support. B, previous support resistance. Or D, we look at fair value gaps. I think this should be quite easy, right? If you still remember, how do we identify order blocks? Okay, cool. Okay, the correct answer is actually A. Okay, it's last opposing candle before a change of character or before structure. Okay, so the person who got it right. Okay, I'm not sure if because WCK Rich got the first question already. I'm not sure if they'll be able to give out 2 times. Okay, so probably only once. You'll be able to win once, right? In the mysterious gift session. Okay, so for this question itself, congrats to Yuk Long and Q Key. Okay, so same thing. Fill up the Google form. Okay, so that we'll be able to send you the gifts. Okay? So third and last question. Okay, which of this statement is correct? A, BOS is a potential trend reversal signal. B, change of character is often used as an entry signal. Or C, break of structure is a break and close beyond swing points. Okay, I think this is quite straightforward. Okay, so which of this statement is correct? A, B, or C? Okay. A is break of structure, potential trend reversal. B, change of character, often used as an entry signal. And C, break of structure is a break and close below swing point, right? Good. So the correct answer is B, C, right? I think all of you who type it in got it correct. But I think the first two over here would be from Muhammad Aiman as well as Crayon Lee, right? But you guys all got the correct answer, right? Break of structure is a break and close. The key is break and close, right? If it's just a break and the market did not close beyond, that's not a BOS, okay? Good. So that's all from me for today's session. For all the winners, make sure you fill up the Google form. Okay, and I hope today's session gives you a better understanding and a good start into order flow, into smart money concept, right? And of course, the strategy that you can use directly to apply in the markets itself. Okay, so that's all from me for today. All the best. Do practice it. Okay, and we'll see you guys in the next seminar. Right?
Thanks for watching.